What's up everyone? Welcome back to ATS Funded. This is your Monday Insight, and today we are going to talk about liquidity, what it is, where it sits, and why it's the single most important concept for understanding how price actually moves. If you ever enter a trade, watch it hit your stop loss and then immediately reverse in your original direction, you didn't get unlucky, you got hunted. Your stop was liquidity and the market came to collect it before making its real move. Once you understand this, you'll never look at the chart the same way. Let's get into it. So what is liquidity in the context of trading? In the simplest term, liquidity is resting orders. It's the buy stops, sell stops, limits order, and pending orders that sits at specific price level of the chart. These orders are the fuel that allows larger participants, institutions, banks, hedge funds to fill their position. Here's the thing most retail traders don't understand. Institutions can't just enter the market whenever they want. They trade with massive size. To fill a position of that scale, they need someone on the other side of the trade. They need liquidity. And where does liquidity sit? It clusters around obvious levels, above swing highs, where buy stops and breakdown orders accumulate. Below swing lows, where sell stops and breakdown orders accumulate. These are the magnets that draw price in. Price doesn't move randomly. It moves from one pool of liquidity to the next. Sweep buy side liquidity, then target sell side. Sweep sell side, then target buy side. This cycle repeats every single session. Once you see it, you can unsee it. That's the foundation. Now let's break down the two types of liquidity you need to know. Liquidity shows up in two main forms on the chart, and understanding the distinction between them is what separates traders who chase price from traders who anticipate it. The first type is external liquidity. These are the obvious levels, the swing highs and swing lows that everyone can see. Above every swing high, there are buy stops. Traders who are short and have their stop above recent highs. Breakout traders have their buy orders here too. Below every single swing low, there are sell stops. Traders who are long have their stops below recent lows, and breakdown traders have sell orders waiting. External liquidity is where the market goes to grab orders. It's the destination. When price sweeps a swing high or low, it's collecting that external liquidity. The second type is internal liquidity. These are the fair value gaps, the imbalances left behind when price moves too fast in one direction. They sit within the price range between the swing highs and low. Internal liquidity represents inefficiency, areas where two-side trading didn't occur and where price is likely to return to rebalance. Here's how to think about it. External liquidity is the target, where price is going. Internal liquidity is the path, how price gets there. Price reaches for external levels to grab orders, then use internal levels as stepping stones along the way. Knowing which type is in play at any given moment helps you stop forcing setup that aren't ready. If price just swept external liquidity, it's likely heading to fill internal liquidity next. If price just fill an internal gap, it's likely reaching for the next external level. That's the rhythm. Now let's see how this play out in real time, because this is where it's all click. Every session, the marks run the same playbook. Price reaches for one pool of liquidity, collects it, and then target the next one. It's a rotation, external to internal, internal to external, over and over again. Let me walk you through a typical sequence. Price opens the session and starts moving toward a previous swing low. Sell stops are sitting below that level. Price sweep the low, trigger those stops, and institutional participants use that liquidity to fill long positions. Now price reverse. It starts moving up, and on the way, it fills a fair value gap that was left behind from a previous move. That's internal liquidity being rebalanced. After filling the gap, price continues upward toward the next swing high. That's the next external target. Buy stops sitting above that high. Sweep sell side, fill the gap, target buy side. That's one full cycle, and it's repeat. Once you start mapping these on your charts, you'll start seeing the same pattern play out session after session. The asset change, the time frame change, but the cycle stays in the same. Price move from liquidity to liquidity, and that's the game. So let's bring this back to the problem we started with. You enter a trade, it hits your stop, and then the price immediately goes in your direction. Why does it happen? Because your stop was liquidity. You place your stop loss at an obvious level, you just below a recent swing low or just above a recent swing high, exactly where the market needs to go to collect orders. This is what a liquidity hunt looks like. Price move to your stop, triggers it, uses your order and thousands of other likes it to fill institutional position and then moves in the original direction. So how do you stop being the liquidity? First, you understand that the obvious stop placement are targets, not safe zone. If every retail traders earn their stop at the same level, that's where the market is going before it makes the real moves. Second, wait for the switch before entering. Instead of entering before the liquidity grab, wait for it to happen. Let the market take the obvious stop and then position yourself in the direction of the move that follows. That's trading with the institution, not against it. Third, use the liquidity cycle to plan your trades in advance. If you know price is targeting sell-side liquidity, you don't go long until it gets there. If you know buy side is the next target, you don't short it until it's been swept. The cycle gives you the roadmap, use it. The only thing that changes from session to session is how you enter. The cycle is the same, the liquidity pools are the same, but your entry methods needs to match the context. If you're waiting for extra confirmation before entering, chances are you are already late. By the time the move is obvious, the smart money is already positioned. The liquidity has already been taken. The traders who consistently extract from the market are the ones who plan before the session. Identify where the liquidity is, determine which pool is likely to be target next, and enter when the cycle confirms their thesis. Plan it, execute it, move on. That's the process. Liquidity is the engine that drives every move in the market. Once you understand that price moves from one pool to the next and that your stop loss is part of the pool, everything changes. Stop being the liquidity. Start reading it. Check your email for the full written breakdown of everything we covered today and subscribe so you don't miss the next module. When you're ready to prove your edge, stop risking your personal capital and get funded with ATS Funded. The link is in the description, and see you at the next one.